Good morning and welcome to this Monday, July 25th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. We've got a good week last week under our belt, got through the 50-day moving average. Did pull back a little bit on Friday, so I was wondering maybe if we'd see a little bit of selling, but so far futures holding up pretty well. We do know historically Mondays are not always great, but again, so far, I think things are holding up pretty well. Looking over at stock charts, I'm going to pull up the diamonds and the QQQ and the spider for you so we can see exactly what we're doing there right now. Get a real-time quote. Diamonds right now are up about 0.4%. They closed on Friday at 319.06, currently at 320.29. So pretty good, start so far, especially for a Monday. The spider up about 35/100ths of a percent, so up about $1.38. From 395.09 close on Friday, right now 396.47. And then the more aggressive NASDAQ up about 0.25%. So it's down a little bit on a relative basis versus the Dow and the S&P, but still up 0.25%. Currently the QQQ trading at 302.74, up from the Friday close at 301.99. So all in all, looks like we're getting off to a pretty decent start today. We'll see whether or not, again, that continues, but at least for now, I think things are looking pretty good as we get ready to kick the week off. And I think this is going to be a big week on a number of different fronts, but we got a lot of economic news. We got a big Fed meeting. Among the economic reports out this week will be the GDP, the first reading of the second quarter. And what it takes to get a recession is 2 consecutive negative readings. We had a negative reading in Q1, and analysts are mixed on whether or not we're going to get a negative reading in Q2. I think the estimates I saw are anywhere from about -1% to, maybe +1 or 1.5%. And the consensus is right around 0.5% of GDP growth. So I don't know. Call it what you want. It's like, saying whether or not you're in a bear market, saying, okay, well, we're only down 19.75%. It's not a bear market because we're not down 20%. Well, for me, the GDP, when we slow down and we're almost flat, we've already had 1 negative reading. This is pretty darn close to, call it what you want, but I think this is probably a mild recession already. But anyway, we get that report later this week. I think that comes out on Thursday. We'll get the Fed announcement on Wednesday. A lot of big economic news. We'll go through a little bit of that in just a minute. First thing I want to do, though, for those of you that are new, let me take you over to EarningsBeats quickly and just kind of walk you through how you can learn a little bit more about us. If you go to EarningsBeats.com, scroll down, we have a free EarningsBeats Digest newsletter. Name and email address is all it takes. We do have free events from time to time. We reach out to this community for our free events, but just from signing up, you're going to get a 3 times a week newsletter, Mondays, Wednesdays, Fridays. Normally we try to get these out before the market opens. So usually around 8:30, about an hour before the market opens, featuring a lot of different things that we look at right now. We're kind of going into earnings season. So I will be taking a look at a lot of companies either just before they report their earnings or maybe after, talking a little bit about that, what I like, what I don't like. Today I featured pretty well-known tech company I am not a fan of going into earnings. I think they could drop a bomb. Could they report better than expected? Sure. Anything goes with earnings, but it's all about risk for me. And I can tell you Wall Street is not impressed with the company as it heads toward its earnings report this Thursday. And so I'm not going to be impressed. Anyhow, if you subscribe to the EarningsBeats Digest, you'll get that information 3 times a week. Love to have you. So please join if you haven't already. All right. So what happened on, well, that's not the right screen. There we go. What happened on Friday? Well, the Dow Jones Industrial Average was down 138. S&P was down 37. NASDAQ down 225. So on a relative basis, you can see down almost 2%. That was clearly the laggard. Mid caps down almost 0.9%. Small caps down a little bit more than 0.9. So it wasn't a very good Friday, but we had a great week leading up to that. So we saw a little pullback, a little profit taking end of the week. Like I said, we got a lot of big news coming out this week, and earnings season really kicking into gear. Got some big ones coming up this week. Got Microsoft, Apple, a lot of the big names, big tech names, as I call this. Well, I don't know if we're quite past tier one, because there are a lot of tier one companies like Apple and Microsoft reporting, but we're starting to get into some of the second tier names. You know, last week and the week before was a lot of the big banks, a lot of the big names, the Dow, many of the Dow components reported. I think through last week, maybe 20 or 25% of the S&P 500 had reported. Well, it's really starting to pick up this week. We got a number of companies reporting, many of them very, very influential in terms of what might happen with the stock market. So yeah, this is going to be a big week. You know, we might be getting earnings reports that may or may not correlate positively with what we see in the GDP. I mean, we could see some earnings reports come in much better than expected, maybe even raising guidance, while at the same time we're getting a GDP report that may show we're in a recession. So sometimes it's hard to balance that kind of mixed information. But I can only tell you one thing about the stock market. It looks ahead. It's always looking forward. It's not looking in the rearview mirror. So the market is not going to go up or down based on what the stocks just did in the last quarter when they report. It's going to be much more focused on their guidance for the second half of the year, what they see. That's what stock market is going to focus on primarily. Doesn't mean ever you get a pass if you report a really bad report, because again, it's going to depend a little bit on what you have to say about the future. But you know, if you keep saying, well, last quarter was bad, but next quarter is going to be better. If you've said that 3 or 4 times in a row now, you know, Wall Street's not stupid. Wall Street will catch on to that. Anyhow, moving on, 10-year treasury yield. 10-year treasury yield currently up a little bit. Let's get the latest. Right now, we're up about 5 basis points to 2.83%. Big down day on Friday. Don't know if you realize that. I mean, that, you know, I see the NASDAQ go down, but then I see the yields dropping like they did on Thursday and Friday from the early part of Thursday through Friday. We're, you know, not too far from a big breakdown. I'm telling you, we go below 2.70%. And that could be the floodgates in terms of folks pouring into bonds, which makes no sense with inflation. I'm not going to go through all that again, but normally at rates, yields would go up if you're worried about inflation, not down. So bond market's pretty smart. We start seeing the yields breaking down, and that to me is like the final nail in the coffin for inflation. So watch 270 to the downside there. All right. Economic reports. I mentioned those earlier. So not really anything out today of significance, but tomorrow the Fed meeting begins. Oh, you know, 2-day meeting, Tuesday, Wednesday. So 2 o'clock on Wednesday, we're going to get the latest announcement. A lot of speculation going on. I think the Fed's been kind of telegraphing a 75 basis point move. A couple of the Fed officials have been out saying, I'd be okay with 100 basis points. So I think it's going to be one or the other. But honestly, I think the wording is going to be more important than the rate hike, because we've seen inflation. Of course, the last reports that came out earlier this month were still highly inflationary, but we did peak on the annual rate. Annual core inflation peaked back in March. Is the Fed going to say something like, hey, we feel like we're making progress and inflation seems to be coming down? Because that kind of wording would paint the picture that maybe they're done. Maybe their work is done, because they got 2 battles to fight. One's inflation, the other's recession. They kind of put recession on the back burner. They want to make sure they take care and squash out inflation. But once they feel like they've got that squashed, they will quickly turn their attention to the recession. And that's when you'll see rates coming back down. Now, I don't think they're going to just turn around and start lowering rates. I'd be surprised, but I wouldn't be surprised if they started to telegraph that, hey, we're going to lower rates, or we could potentially lower rates later this year or early next year if we need to with the economy, and if inflation is in check. I mean, it could be some kind of wording. I'm not putting words in their collective mouths, but watch the wording. I think that's going to be the important. And anyway, that comes out Wednesday afternoon at 2 o'clock. So you can see a lot of volatility in the market come Tuesday or come Wednesday afternoon. Also on Tuesday, Case-Shiller, FHFA house price index, consumer confidence, new home sales, all of that coming out on Tuesday. Wednesday, we got durable goods, pending home sales, and then, of course, that FOMC announcement. Thursday, GDP and initial jobless claims. And then Friday, personal income spending, Chicago PMI, consumer sentiment. We got a ton of economic news coming out this week, including that Fed announcement, and earnings season is rapidly accelerating. So there's going to be a lot going on in the market. And when I look at the S&P 500, we're getting closer and closer to some key levels. Now, one of the things I talked about with our members this weekend in the our weekly portfolio report, a couple things to watch. Right now, for me, to the downside, I'm watching this rising 20-day. Because when you're trending higher, you normally trend above the 20-day. When you're trending lower, price tends to trend below. And when you keep going up above and below these moving averages, you can see back in June, above the 20, below the 20, above the 20, below the 20. You're doing nothing. That's a trendless environment. Moving averages should offer support when you're trending higher, and moving averages should offer resistance when you're trending lower. So here we've broken out above both the 20 and the 50. The PPOs turned positive for the first time since back in, we went back negative in mid-April. So this is the first time we've kind of gotten our head back up above water here in terms of the PPO. Already talked about all the rotation that took place. A lot of folks look at the market and they say, okay, well, this is the same thing it did back in March. So we're getting ready to go back down. Well, I'd be a little careful with that line of thinking, because back in April, or back in February, March, at these lows, and even on this rally, we were still setting lower lows on all of our sustainability ratios, those key intermarket relationships. That changed in June. When we went to this new low, all of our sustainability ratios printed higher lows, showing that Wall Street was actually rotating back into aggressive areas of the market. We didn't have that back here when we made this rally. I think that was more Max Pain options induced. Those 4 days right there saved or made market makers billions of dollars. And then we went up a little bit more after that, another 4 or 5%. And then we went right back down, continuing the cyclical bear market. This is a little bit different, though, in my opinion, because again, money rotated. We already saw what possibly could be the bottom, which we did not see back here, had none of those signs. So now we got the possibility of a bottom, and prices now starting to move above moving averages. This is going to be more important to me. I'm not ruling out the possibility of maybe going back down, putting in a double bottom. I think it's still possible. We've got, still Fed to get through. We've still got inflation story out there a little bit. Of course, the recession. We got August and September dead ahead. These are the 2 worst months of the year historically. There's a lot of things that the market would have to overcome to simply just go back to the upside. But it's also possible we do that. Back here in mid-June, this is when I was saying I went all in. I saw the signs. When I see the signs, I talked about the signs on the way down that I was looking for. I wanted to see that money rotate. That's what we got. So I'm okay, especially with retirement, where I'm just kind of doing a little bit more buy and hold, of getting in and just seeing what happens. And I haven't traded. I haven't traded in my retirement accounts since here. I just went long. QQQ, that was it. Because I believe we're in a secular bull market. I think that the cyclical bear bottomed, and coming out of that, normally you're going to see the QQQ outperform the spider. So if I believe that we're in a secular bull market and I believe the QQQ is going to outperform, that's what I want to own. So just like at the top, when I was saying it was, the market was showing a lot of signs that we were potentially topping, and the fact that it was just too risky to hold. Now I'm saying in June, it's too risky to stay in cash. That's all. You know, will it turn out to be the bottom? I don't know. I think it will, but I don't know for sure. But what I do know is that it was too risky to stay in cash and keep looking for lower lows. Not that we couldn't get them. Again, it's all about risk management for me. And I had a couple comments come in recently saying, you know, yeah, we know you called the bottom. You don't need to keep talking about that. It's really not about calling the bottom for me or calling the top. It's about managing risk. When I see the signs, I'm going to follow the signs. When the charts are telling me to make certain moves, that's when I'm going to make those moves. So anyway, to the downside here, I would be watching this 20-day, because if we do go back down and close below it, and we had a little head fake here, by the way, we went barely above the 20 last Monday, we went back down, and then Tuesday we came storming right back up through it. If we go down, test that 20 and then move back to a new high, that's a really bullish sign. If you notice, the other times we've done this year, above the 20, back below, above the 20, back below, above the 20, came down, tested it, back below, above, back below. Here we went above it, kind of rode along on top of it, and then right back down below, above, below, above, below. Now I'm sounding like a broken record. Well, if we go down, test it, and then we go to new highs, it'd be the first time we did that this year. That would be a bullish sign. Now, from a price perspective, a lot of people just look at price. They don't look at intermarket relationships. From a price perspective, yes, we have some more work to do here. Because if you, I mean, you know, when I start looking at price action and when that, you know, confirms, I would just, you know, do something like this. That's kind of 0.1 in this to me. Could even, you know, make this way over here, but I'll go here, 0.1. And then up here, whoops, we got 2. And then here, or actually, I would maybe drag it over here. That's the low close. This went a little bit lower in intraday, but this was the low close. So here was 1, 2, 3. Now this one, this was a little bit of head fake because it did go above that 2 there. Let's just go ahead and put this in. That's 4. And then we come all the way down. That was a rough patch through April. 5. I'm going to put that right here because that's kind of the low close again. And then we bounce back up 6. There's your reaction high. And then come back down one more time. 7. And now we're still in this downtrend. So here it is. 1, 2, 3, 4, 5, 6, 7. Got to get through this level and stay there. You know, I wouldn't be surprised, and I've talked about this a little bit, wouldn't be surprised maybe if we see something like a reversing head and shoulder form. So maybe something like this, where we have a slight upsloping neckline. Maybe on this move, we can get up to 4,200 somewhere down the road, next couple of weeks maybe. And then August and September, maybe come back down 3,900 or so. Maybe we get the bottoming right shoulder during those really bad months of August and September, and then explode out of this bottoming pattern in the fourth quarter. That's a possibility. I don't know if that's how, you know, not every bottom sets up with a head and shoulder, reverse head and shoulder, but that's one pattern I'll be looking for. Anyway, that's how I'm looking at the S&P 500 right now. I love what's going on. I love what's taking place here, moving back through this double top. That was good. I like all these hollow candles, especially going down. I mean, this going down, you see all these big red candles in this downtrend, a lot of big red candles, big red filled candles. See all these red filled candles? This is all distribution. When you start going down, I mean, really since the June bottom, we've had one really big red candle there. And last Monday was a little bit of a red candle. Otherwise, it's been almost all hollow candles. This tells me it's accumulation. Even when we finish lower, we finish on the highs. hollow candles. To me, this is manipulation. This is distribution. This is manipulation. Yeah, we gap down. We make everybody think we're going back down, but we don't. And now we're at, we're up on the S&P 500, 3636. We went up over 4,000 on Friday. That's 364 points plus 12. That's 376 points off the bottom. What's that? 11%. It's a big move. And if we look at the NASDAQ 100, we were down to almost 11,000. We just got up to 12,600. 12,662 high on Friday from roughly 11,000, maybe slightly above. It's probably 13 or 14%, maybe 15%, not that high. And that's what I was saying. Usually when you come out of these bottoms, the NASDAQ 100 outperforms the S&P. So while we might have 11% on the S&P, we probably got about 14% on the NASDAQ 100 off that bottom. Anyhow, so yeah, I think the market's looking, looking pretty good, and looking better. Are we there yet? No. This is a process. Sometimes you go straight down, you go straight back up. Back at the beginning of the year, when we had Market Vision 2022, that's essentially what I drew a picture of before all of this started. This was back here, right here. I drew a line that went to the end of June down to about 3,700 on the S&P 500. So if we go back to the S&P, so right about here, I drew a line to the end of June that came down to 3,700. That was not a bad call. Got down 3636. Now on the chart, I showed second half going back up. And I still see that. The only question I have is whether or not August and September are bullish, turn out to be bullish months, only because, again, historically, they make me nervous. But we've already lost a lot of ground this year. So this could be the year when both those months are pretty decent. But I do think by the time we're in the fourth quarter, we're going to be flying back to the upside. And I mean flying. I think we're going back to all-time highs. Maybe not this year. I wouldn't rule out this year. But by next year, I am absolutely in the camp we'll be at all-time highs. I think the end of next year, we could finish 5,500, 6,000. It's a pretty long way from 3,961. We'll see. All right. I wanted to just mention, for those of you who are not part of that newsletter that I talked about, one thing that we do, this is a pretty cool feature. We feature earnings chart lists for free. And what we do is, let me bring up, where is it? Right here. So right here, this is a chart list of all the companies that report earnings this morning. All right. So there are only 9 of them, I think, with over $1 billion in market cap. One of them, though, was Newmont Corporation. I don't know if you've followed. I think last week, Newmont was around $55, 54, 55. And I said, I think it's going down here to test these lows. Well, it got down there. In fact, it closed at a new low. They came out this morning. They reported their earnings. Look at this steep slope to the downside. Know what their earnings were? 46 cents. They were expecting 60 cents. A miss. Think Wall Street may have known. 86 down to 52 right before the bomb drops with earnings. Now, I have not even looked. I don't know if this could be a sell on rumor, buy on news, or maybe it extends. I have a feeling wherever it goes, if it gaps down, I have a feeling it probably is going to rally later today, just because it's been down so much. Actually, it's up a little bit. I think probably what'll happen is it gaps up a little bit at the open, goes back down, sets a new low, probably just to scare everybody out, and then probably comes back up again. And I'm only saying that because when you look at the stock, it's at a pretty key support level coming across here, 51 to 52. That's where it's been in the past, and that's where it's found buyers. So I think today, if it opens up a little bit and then goes down, scares everyone out, comes back up and closes. That could be it in the short term for a while. Maybe we get a bounce back up into the mid 50s. But that chart list is pretty cool because what you can do, and I'll show you this in just a few minutes when the market opens, but you can use this view all, go to the summary, and when the market opens, you'll have every company that's reported since the prior close on one chart list. And you can see which ones are getting positive reactions, which ones are getting negative reactions, all on one chart list, which is cool. Now, this is just, there's not many on this list, but let's go out and let's take a look at what we would have later this week. How about Thursday afternoon after the market closes into Friday before the, or maybe even Wednesday after the market closes into Thursday morning. Let's look at that one. So here, let it load. Get some water while it's loading. There we go. Now, if you sort this by number order, you'll see that this is in basically market cap order. So you're going to have the largest companies first. 0001, that's the afternoon. That's the afternoon that's Wednesday afternoon earnings. 001, it's in market cap order all the way down to 0100. So you come all the way down here. There's 100 companies with market caps over $1 billion that report earnings on Wednesday after the close. Then we start 1001. That's Thursday morning before the open. Highest market cap companies, MasterCard. Then you got Hershey, Pfizer, Merck, and so on. How many are in the morning? Well, we go all the way up to 1,000, 1,116, 116. So you got 116 in the morning. You got roughly 100 or 101 or 100 in the afternoon the day before. And there you can see we have 216 stocks on this chart list. And what's really interesting is if you bring that up on Thursday morning in summary form, it'll give you the best performers. We can do it in change order. It'll give you the best performers or the best reactions right at the opening bell on Thursday. 216 companies that just got new fundamental information, and you got one chart list that summarizes it all for you. And it's free to anybody who's a subscriber of our EB Digest. Now, in order to pull it up into a chart list and save it into a chart list, you have to be a member at Stock Charts. But this would be a great time to try a 30-day trial over there. It's free. You could do a 30-day trial with EarningsBeats, 30-day trial of Stock Charts, pay $0, and go right through the heart of earnings season with some pretty good information and great charts. Anyway, I'm going to come back to these in just a minute. Market's getting ready to open, but I wanted to go through and show you the three you must see. A couple of stocks. First, Sprout Social. Got the AD line, which looks really strong. Price action, just been going sideways, but it's in a group that's been continually moving lower. So this is a stock that actually has shown a little relative strength. And back at the end of June, it was at about a 7-month relative high versus internet stocks. So it's pulled back recently, but I think this 54 area is where the stock needs to hold. I mean, there's really not much to hold it until you get down to mid 40s if 54 doesn't hold. I think we're going to see the stock turn back up. Sprout Social. So that's one I wanted to show you. Dropbox is one that I'm really getting interested in. AD line looking strong. I like this sideways action. It's trying to get through this. I want to see this breakout above about 23.5. We opened at 23.35. Put in bearish engulfing. Looks like bearish engulfing. Might be dark cloud cover. Can't tell if we completely cover up that body, that candle body from Thursday. But anyway, not a great looking candle either way. But I think we could get a pullback. Maybe we get back to $21, maybe to one of these moving averages. But I believe we're going to turn and move higher on Dropbox. Dropbox, look at the relative strength versus software. It's been steadily improving throughout the year. So while the price has been going lower, its relative strength has been improving. If software and the market overall continues pushing higher, this would seem like to be like a pretty logical winner. Last one I have for you is ISRG. Had a member write in and ask about ISRG and would I take a look at it now that the earnings have reported. Well, one thing last week, I did an earnings, second quarter earnings sneak preview, and I talked about companies that were likely to not report very good numbers. ISRG was one of them. I mean, look at its relative strength versus the S&P. Look at its relative strength versus its medical equipment peers. Wall Street doesn't like the stock. They came out and they missed their earnings numbers. They came up short on earnings. It wasn't a big surprise the way they had been trading. You get a lot of traders see this right before earnings. They're like, oh, it's going up. Somebody knows something. Well, if somebody knows something, it's going to be in the months leading up to the earnings month. It's not going to be in the couple of days before earnings, because these companies, once their quarter ends, and ISRG's quarter ended, I believe, June 30th. Once their quarter ends, it's a quiet period. No one's allowed to talk to the company. So this movement isn't because somebody knows something. I hear that all the time, traders. Oh, it's going up. Somebody knows something. No, they don't. Not based on these 3 days, or it's insider trading, or it's going against all the SEC rules. Can't talk. It's a quiet period. What was it doing heading into its quarter end, end of the quarter? That's when Wall Street was meeting with management. What was ISRG doing? Going down relative to both the S&P and its peers. So the only move to the upside was during the quiet period. That was just a little bit of a counter trend move. Now, what do I think about ISRG? I think it's a great company long term. Short term, I need to see some more out of it. I'd like to see it get back up, maybe clear this high. I want to see it start to show relative strength. Why would I want ISRG? I'd rather go into medical equipment and go find a stock that's leading the medical equipment group higher. So I think the stock still has a lot to work on here. All right, last thing I want to do before we go is I want to go back and I want to show you now the reaction this morning's earnings that came out. So here it is. Now, this is just 9 companies, but I think very quickly I can see every company that reported this morning with market cap over $1 billion. Here's your market cap over here, by the way. But I can see every one of them and how they opened. Now, this doesn't mean that they're going to go, higher or lower. There's Newmont, by the way. It actually opened down. So if we pull that chart up, take a look at it. Look at it. 49.22, all of a sudden down 4%. So forget about opening up. But what I would look for now, I wouldn't be doing anything at this point. It's breaking down, so we don't know. But if it recovered later today and printed a big hollow candle, that probably would be the low, because I imagine volume is going to be higher. We might see 20 or 25 million shares today on Newmont. So how we close today is going to be the key there. Right now, we're breaking down. I wouldn't touch it. And I would say most technical analysts would not touch it because it's breaking down. The only reason that you'd have a hollow candle is if market makers are accumulating. And so that's why reversing candles are so important. But anyway, I mean, you could see, imagine when we get later in the week and we've got 216 companies reporting between Wednesday afternoon and Thursday morning, trying to go through and figure out how they're doing one by one is going to take a long time. Put them all in one chart list. That's what we do for you. You can take a look, see which ones are strong, which ones aren't. You can look at the volume. I mean, this company's up 1%, but it's on 800 shares. That's all. I mean, I could have done that. That could have been mine. 800 shares. That's nothing. So you got to see some volume coming in. Squarespace, this one down 7%, 94,000. See what's going on here. Well, this one, let's see if it opened above. All right, 1852 was the open. This prior close was 1863. So this opened below that support level. I don't know where this is going to go today. My gut feeling says it's going to go down. just because it opened beneath that prior close. Sometimes that gives a little bit of a clue. So yeah, it's up early, but I wouldn't be surprised, if I really was wanted to be aggressive, I'd short it and see if this thing breaks back down again. If you do that, you're doing it on your own, by the way. I'm just speculating here, but I wouldn't be surprised to see it move back down later and maybe close down in the 17s or even 16s. Would not surprise me. But if you do short it, just make sure you keep a stop in play. It could absolutely go. There's certainly no guarantees. All right. Anyway, that's it. Let's take a look, see what the market's doing, then we'll wrap this thing up. I know we ran a little bit late today. Currently, NASDAQ down 37, S&P down 5, Dow down 23. So those green futures went away pretty quick. We'll see whether or not we get that pullback. Again, for the S&P and the NASDAQ, all the major indices, watch those rising 20-day moving averages. I think that's going to be the key. If we can hold those and we move back up to new highs, I think that would be very bullish. All right, everybody have a great rest of your day. I'll be back tomorrow over at Stock Charts TV. By the way, we are having an earnings webinar today, an earnings event at 4:30. It's a member-only event. But just like I predicted the ISRG, not so good news based on how it was trading into earnings, I'm going to be looking ahead to the next couple of weeks and taking a look at the companies that I believe are going to come out with strong reports, companies I believe are going to come out with weak reports. And then you can keep report card and see how we did. But I believe in looking at relative strength more than anything else heading into an earnings report. At least if you're going to hold into an earnings report, have knowledge that supports that position. I think that's the riskiest day of the year to hold a stock or of a quarter when you're holding into an earnings report. Anything goes. Even if the chart looks great, it might be because Wall Street went out to management. Management was rah, rah, rah. Everything looks great, looks great. And then they drop a bomb because they kept thinking the numbers were going to be okay and they weren't. And then you get killed, so nothing is a guarantee. Nothing is a guarantee in the market. But I do think it can give you better odds. And that's what you're always trying to do. You're trying to get better odds. Anyway, love to have you for that. Come on into EarningsBeats, sign up for a 30-day trial, and you can join me tonight for that event. But tomorrow, your next Trading Places live, of course, it'll be the recorded version, will be over at Stock Charts TV at 9 a.m. So hopefully see you there. Have a great day, everybody. Happy trading.